Certainty is the most dangerous signal in a market built on uncertainty. And yet, every cycle it arrives dressed as confidence, packaged as a prediction, and repeated until it feels like inevitability. A crystal ball says XRP will hit a specific price by May. The number is precise, the timeline is near, and the conviction sounds absolute. But here is the contradiction most participants fail to confront. If the outcome were truly that obvious, the market would have already priced it in. There would be no opportunity left, no asymmetry, no edge. So the question is not whether the prediction is right or wrong. The question is why such predictions emerge at specific moments in the cycle. Because they are never random. They tend to appear during phases of maximum confusion, when price action feels disconnected from narrative and when conviction is quietly being tested. And this is where it becomes interesting, because what looks like a bold forecast on the surface may actually be signaling something far more important beneath it. Something that has very little to do with May and everything to do with positioning. What makes the current environment difficult is not volatility. It is the absence of it. XRP is not collapsing, but it is not accelerating either. It exists in a state that feels almost engineered to exhaust attention. The narrative remains strong. Partnerships, use cases, regulatory progress, these are not disappearing. And yet, the price does not respond in the way most expect. This creates a psychological conflict. Retail investors are conditioned to associate strength with immediate upward movement. If the story is bullish, the price should reflect it quickly. When it does not, the assumption shifts toward weakness or worse, irrelevance. But that assumption reveals more about participant conditioning than it does about the asset itself. Because markets do not reward clarity in real time. They reward positioning before clarity emerges. And in phases like this, price action often appears disconnected precisely because the market is transitioning between participants. But that is not the most important part. What matters more is what this type of price behavior has historically represented in previous cycles, not just for XRP, but across the broader digital asset market. The mistake most participants make is assuming that price reflects value in real time. It does not. Price reflects urgency. And right now, there is very little urgency in XRP. Not because interest is absent, but because strong hands are not chasing. They are waiting. Absorbing, positioning without signaling intent. This is not stagnation, it is transfer. A slow migration of supply from impatient holders to those operating on a longer time horizon. And that process, by design, feels uneventful. It lacks the emotional spikes that attract attention. It creates doubt. It tests conviction. Retail interprets this as inactivity because it does not resemble momentum. But institutional behavior rarely does. It is quiet, methodical, and often invisible until it is complete. By the time price begins to move with speed, the positioning phase has already ended. And this is where it becomes interesting, because if this is indeed an absorption phase, then the current lack of volatility is not a warning sign. It is a condition, a necessary environment for accumulation to occur without disruption. But to understand whether this interpretation holds weight, we need to step outside of XRP itself and examine the broader signals coming from those who influence capital flows at scale. When you step back from the noise of daily price action, a different picture begins to form. The conversation at the institutional level has not weakened. If anything, it has become more deliberate. Figures like Tom Lee are not known for impulsive commentary. Their role is to interpret macro conditions, liquidity cycles, and capital rotation trends, not to chase short-term narratives. And what they consistently emphasize is not isolated assets, but the broader structure forming around digital finance. Large firms such as BlackRock and Franklin Templeton are not entering this space to speculate on weekly price movements. Their positioning reflects a longer-term thesis centered on infrastructure, tokenization, and financial rails that can support global liquidity. Within that framework, assets like XRP are not evaluated based on short-term volatility, but on their potential role in facilitating settlement, cross-border flows, and institutional-grade liquidity solutions. That narrative does not require immediate price expansion. In fact, it often precedes it by a significant margin. But that is not the full picture. Because even with institutional alignment forming in the background, there remains a layer of uncertainty that continues to suppress immediate market response. And this is where the regulatory dimension begins to exert its influence. Even with growing institutional alignment, the market remains constrained by a variable that does not move on sentiment or momentum. Regulation, it sits in the background, slow, procedural, and often misunderstood. And yet, it has more influence over capital deployment than any short-term narrative ever could. For assets like XRP, this layer carries even more weight, because its positioning has always been tied to compliance, cross-border settlement, and integration within existing financial systems. That is not a speculative narrative. It is a structural one. But structural narratives take time to resolve, and until they do, the market tends to discount them. This creates a unique tension. On one side, there is visible progress, legal clarity improving, institutional conversations advancing, infrastructure being quietly built. On the other side, there is hesitation. Not rejection, but delay. Capital at scale does not move until uncertainty is reduced to acceptable levels. And this is where most participants lose patience. They expect resolution to align with their personal timelines. When it does not, they interpret delay as failure. But delay, in this context, is often part of the process. Because once that uncertainty begins to compress, the shift in behavior is not gradual. It is sudden. And by the time it becomes obvious, the opportunity to position cheaply is already behind. What most participants fail to recognize is that XRP does not move in isolation. It reacts to liquidity conditions set elsewhere, primarily through Bitcoin. And this relationship introduces a delay that often confuses those expecting immediate performance. When Bitcoin enters a phase of strong expansion, it absorbs the majority of incoming capital. Attention consolidates, liquidity concentrates. Altcoins, including XRP, remain relatively subdued during this period, not because they lack potential, but because they are not yet the focus of capital rotation. This creates the illusion that XRP is underperforming. In reality, it is waiting for a different phase of the cycle. Historically, meaningful XRP moves tend to occur after Bitcoin stabilizes, when capital begins to distribute outward in search of higher relative returns. That transition is rarely announced. It is felt through subtle shifts in dominance, volume, and correlation structures. And this is where it becomes critical, because timing this rotation is far more important than predicting an exact price level. A projection for May capture attention, but it does not capture the mechanism that would allow such a move to happen in the first place. The real edge in markets like this does not come from predicting exact outcomes. It comes from recognizing phases before they become obvious. And right now, the majority is still focused on confirmation. They are waiting for price to validate the narrative, for momentum to return, for certainty to replace doubt. But by the time those signals appear, the asymmetry is gone. The opportunity shifts from positioning to participation, and the risk-reward profile changes accordingly. This is why patience is not just a passive trait. It is an active strategy. It allows you to exist in the phase most people avoid, the phase where doubt is highest and conviction is tested. For XRP, this phase is particularly uncomfortable because it lacks reinforcement. There are no immediate rewards for holding through stagnation. No clear signals that validate the decision in real time. And yet, this is precisely where positioning tends to occur. Most participants will not endure this phase. They will rotate out, seek momentum elsewhere, and return only after the move has already begun. And when they do, they will believe they are early, even though the structure has already shifted. So, when a figure like Tom Lee suggests a potential price outcome within a defined time frame, it should not be interpreted as a literal forecast to anchor your expectations to. It is better understood as a directional signal, a reflection of underlying conditions that may already be forming but are not yet visible in price. Because the market does not reward those who follow headlines. It rewards those who understand structure. And structure, by its nature, unfolds slowly, quietly, and often without confirmation until the final phase begins. The question then is not whether XRP will reach a specific number by May. That question assumes that timing and price are the primary variables that matter. They are not. What matters is whether you recognize the phase you are in and whether your positioning reflects that understanding. Because if this is indeed a period of absorption, of silent accumulation beneath the surface, then the lack of movement is not a flaw in the thesis. It is part of it. And most will misinterpret it until it is too late. By the time the market provides clarity, the opportunity will no longer require conviction. It will require speed. And at that point, the advantage will belong to those who no longer need to be convinced.